Imagine you had $382 billion sitting around. Yes, billion with a B. What would you do with $382 billion? Today, I want you to walk in the shoes of Warren Buffett and his team at Berkshire Hathaway with that kind of firepower. Because what Buffett is doing with his cash pile tells you more about the market, about your investing strategy, and about your timing than a lot of other things, right? In fact, you probably find out more from what he's not doing with his pile than what he's doing. So at least these three things. Number one, what Buffett's record cash haul means for you. This is an all-time record for a company to sit on this much cash. Number two, what he could do with it and why he probably won't do those things. And number three, what lessons should you take away for your own investing or business strategy? So stay with me and we'll talk about dry powder and $382 billion, which is more cash than the total market cap of tons of iconic companies. I mean, Coca-Cola, Buffett's a huge investor in Coca-Cola. Total market cap, $295 billion. Toyota, $266 billion. T-Mobile, $231 billion. Disney, $200 billion. Intel, $178 billion. AT&T, $173 billion. So any of those companies he could buy, including McDonald's, which he famously, when he's having a good day in the stock market, he'll buy like a $3 or $4 sandwich at McDonald's. And when he's having a bad day, like a $2 sandwich. He could easily buy all of McDonald's. So the big picture, what's going on? Berkshire Hathaway's cash and cash equivalents, like treasury bills, just hit $381.7 billion in the third quarter. That's a new record by far. It's a mind-boggling amount of capital sitting on the sidelines, not a few hundred million, but a few hundred billion. And why should you care? Well, when Buffett, one of history's greatest capital allocators, chooses not to deploy that much capital, it seems like it's signaling something for you and for me, right? So Berkshire's operating earnings rose 33 to 34% year over year in Q3. So it's not that the company's hurting. Their insurance in particular is doing really well. But Berkshire is not aggressively buying new companies. They're not repurchasing their own stock. Instead, they're just accumulating cash and treasury bills. Net stock sales continue for Berkshire. They continue to sell more stock than they buy. And that says something about Buffett's view of the public markets and what Buffett believes is valuable. So here's the first key takeaway. When the top allocator in America says, I'm waiting, maybe you should ask, what am I waiting for? Because timing, when you deploy capital, matters as much as what you deploy it in. So it's interesting to watch his timing. And if you think about all the things that Berkshire Hathaway could do with that cash, like a little game of what if you want to think like Buffett for a moment, with $382 billion, they could do a lot. I mean, in theory, they could buy a number of huge companies like McDonald's or T-Mobile that we talked about earlier, but in practice, there are major constraints, and that teaches you some important lessons. I mean, they could acquire a large, high-quality business outright. With that kind of money, you could buy many of the most iconic U.S. companies, or a company like Toyota. It's not even a U.S. company. You could use the cash to buy back Berkshire shares at an attractive price if you thought the stock was undervalued. You could invest in their hugely diversified operating business. I mean, they own insurance, manufacturing, railroads to grow organically. But, when you think about this huge amount of money, $382 billion, finding a company large enough, but also at the right price would be really hard. In fact, it would be hard to just buy up all the stock of American Express, for instance, which they already own quite a bit of. You typically are going to pay a 20 to 40% premium to try to get a deal like that done. Also, from a regulation standpoint, integration, execution, there's a lot of risk there, right? Like buying big means dealing with antitrust, cultural alignment, capital allocation issues. And Berkshire tends to prize simplicity, so I think they're going to stay away from that. Also, Buffett's 95 years old, and he's already announced that in January of 2026, next year, he's going to be handing over the CEO role to Greg Abel. The younger leadership might be conservative as they're stepping into those shoes. They're probably not going to want to just step in and right off the bat make a huge purchase. Also, valuations are high, right? Buffett is wanting to buy things that he sees as a bargain. And evidently, he's holding a lot of cash because he doesn't feel like he sees any bargains right now. So if you have capital to deploy in your business or your portfolio, you might ask, are you seeing bargains, or are you deploying money just because you have the cash to spend? Holding cash or treasury bills is not a sign of laziness. It can actually be a competitive advantage if you're disciplined and you're waiting for the right opportunity. So when everyone else is chasing deals, sometimes the best deal is to sit on the sideline. And, Buffett's signal, what does it mean for the market? What does it mean for you? This is all perspective. I'm not a financial advisor, so you can't take this to the bank, but it seems like what Buffett is doing or not doing often sends a signal to the broader market, and you can use that to inform your own strategy. There's something called the Buffett indicator, which is the total US stock market cap divided by the total US GDP, or gross domestic product. And right now it's north of 220%, which is scary. Buffett has previously warned that above 200% is playing with fire. So when you look at lately versus the S&P 500, Berkshire has underperformed, probably because Buffett has been so averse to high valuation tech stocks, which are really what's driving the market up right now, stocks like Nvidia. So Buffett's cash buildup suggests he doesn't see enough value opportunities at current prices. The translation for you, if you're invested heavily now, you might want to ask, am I buying because I believe in intrinsic value or because momentum is so strong? If you have business capital to deploy, maybe ask yourself, am I playing for the long term or am I just reacting to hype? If you're holding cash or dry powder, as we sometimes call it, that's okay. In fact, it might be really smart. You don't have to deploy cash just because you can. You could almost visualize it this way if you're a hunter. I'm not really a hunter, but one of my sons is. Buffett is like a hunter on a mountain with his rifle loaded and his scope zeroed in, but he hasn't pulled the trigger yet. Why? He's still waiting for the right deer in the right valley. And maybe you should be doing the same in your investing or your business strategy. Let's bring this home with some very practical, specific lessons that you can use. What can you take away from the fact that Warren Buffett at 95 years old and Berkshire Hathaway are holding an absolutely huge pile of hundreds of billions of dollars of cash? I think first lesson, capital equals opportunity only when the price is right. So only make use of your capital when you find the right price. Buffett's holding hundreds of billions of dollars for a reason. You shouldn't deploy your capital until you see something undervalued, something you understand. In your business or your portfolio, be like that. Lesson number 2, discipline beats exuberance. It's easy to get so excited. Oh, I can buy this. When markets are frothy, everyone wants in, but the best returns often come when you're patient and you position yourself ahead of the crowd. And sometimes that's by holding dry powder. Lesson 3, know your circle of competence and stick to it. Know what you're good at and know what you're not good at, and don't step outside your circle. Buffett avoids what he doesn't understand, especially the speculative tech, AI frenzy, crypto, all of that. We should as well. You should avoid what you don't understand. Your biggest wins often lie where you have your deepest understanding. Number 4, I've alluded to it already, but having dry powder is a strategic advantage. In business, if you have cash when others don't, you can act while others are forced to retreat. In investing, when market sentiment reverses, you'll be ready to deploy. And lesson 5, strategy matters more than timing alone. Buffett has one-of-a-kind scale. You likely don't. You obviously don't. I don't. I might be well off, but not to hundreds of billions of dollars. But you do have the advantage of agility. You may not be able to move $382 billion, but you can move when others hesitate. So ask yourself, do I have the cash or the resources waiting to be deployed? What's an opportunity that I understand deeply? And am I comfortable not acting until the right opportunity comes along? That's actually a powerful positioning point if you're comfortable to wait. Am I prepared for the moment when valuations correct or when cracks appear? Because if you are, you'll be sitting in the same mindset as Warren Buffett right now. And that's a powerful place to be. What should you watch for over the next 12 months? Here's what I'm kind of watching for, what I'm curious about, several different things. With Buffett stepping down as CEO of Berkshire Hathaway at the year end and Greg Abel taking over in January of 2026, it'll be interesting to watch how quickly or how slowly they start deploying the hundreds of billions of dollars of capital that they're sitting on. Watch for large acquisitions from Berkshire. If they happen, there'll be clues about opportunistic pricing and where Buffett's team sees a lot of value. Monitor the buybacks. It's interesting, when they feel like their stock is too low, they'll buy a lot of Berkshire stock, but they haven't done that for quite a while now. So if Berkshire starts repurchasing its own shares, that'll be a signal that they think their own stock is undervalued. Keep an eye on valuation multiples in your own portfolio. When was the last time you were able to say, this is cheap relative to what I know or relative to what this stock has been historically? It's important. I'm for the most part, a value investor. Watch the interest rate environment, inflation, watch macro risks, because Buffett's caution is not just about markets, it's about the economy underneath the markets. And I know that's a lot, but in many ways, as an investor, our job is to try to translate various macro signals into micro action. If the Oracle of Omaha is waiting, you can too, but with purpose and with expectation that there will come a chance when you get to deploy your dry powder. Let me leave you with this. Having cash is not a failure, it's a choice. When you choose to sit on cash or maybe something like treasury bills or putting your money in CDs while being ready to act, you're practicing one of the most underappreciated tactics in business and investing. So right now, ask yourself, am I deploying because I want to, or because I have to? And if you answered because I want to, because you think there's good value where you're investing your money, then you're thinking like Buffett and you're already ahead of so many people. But if you answered, well, I'm deploying my cash because I feel like I have to, then pause, step back, let the opportunity come to you rather than you feeling like you have to rush to it. Thanks for watching. I hope you found this valuable. If you did, you can hit the like button, subscribe, ring the bell so you don't miss our next deep dive into business strategy, investing, or the mindset to win. See you next time, and I hope that you have a super day.